All right, let's get right into it. Today, we're tackling the big one, the question on every investor's mind. Are we in a bubble, or is this just a fantastic opportunity? We're going to break down the objective toolkit the pros use to actually tell the difference. I mean, you know the feeling, right? It's the question that keeps people up at night, especially when the market is just ripping higher. On one hand, you feel great, but on the other, there's that little voice in the back of your head just wondering, is this party about to end? Because let's be totally honest, when your portfolio is glowing green, it's just so easy to get swept up in the good times. That optimism is contagious, and well, questioning it feels kind of pessimistic, doesn't it? But then, if a correction hits, that euphoria just evaporates and flips instantly into regret. Suddenly, hindsight is 2020, and everyone's scrambling, trying to find the clues they missed. It's this painful cycle of euphoria and regret that we really want to try and avoid.
So here's the most crucial point. To get a real answer, we have to tune out the emotional gut feelings. We have to ignore the noisy headlines. What we need are objective tools. Think of it like a doctor using a thermometer to check for a fever instead of just guessing based on how a patient says they feel.
And today, we're going to open up the professional's toolkit and look at the 3 key thermometers they rely on. We'll look at the market from a historical view, a macroeconomic view, and a relative view. See, any one of these on its own is just a sign. But all 3 together, that's when you start to get a really powerful systematic picture. Okay, first up, the historical thermometer. We're going to use a tool called the Shiller PE ratio, which you might also hear called the CAPE ratio. This basically helps us figure out if the market is expensive compared to its own past. So what is this thing exactly? Well, a normal PE ratio just looks at price versus 1 year of earnings, and that can be really misleading. The CAPE ratio is way smarter. It smooths everything out by comparing the current price to the average earnings over the last 10 years, and it adjusts for inflation. It's all about filtering out that short-term noise to find the real long-term signal. Here's a great way to think about it. Imagine you're buying a restaurant. 1 year, there was this huge festival right outside, and profits went through the roof. But the next year, the city tore up the main road for construction, and business was just awful. Looking at either of those years alone gives you a totally skewed picture, right? But if you look at the 10-year average, now that tells you the restaurant's true underlying value. That is exactly what the Shiller PE does for the stock market. And this chart just illustrates the point perfectly. Historically, the average Shiller PE for the S&P 500 is around 17. But look at the peak of the dot-com bubble back in 2000. It rocketed all the way up to 44. That's not just a warm market. That is a raging fever, a crystal clear warning sign from history. But here's where it gets really powerful. The CAPE ratio isn't just some bubble detector. It's also a tool for forecasting your expectations. The data shows this incredibly strong correlation. The higher the CAPE ratio is today, the lower the average returns tend to be over the next 10 years. It's kind of like telling you the potential price you're going to pay down the road for today's high valuations. Okay, let's move on to our second thermometer and see how this all starts to build on itself. The macroeconomic view. And for this, we're going to use the famous Buffett indicator. This tool connects the world of stock prices to the real-world economy. The concept behind it is actually beautiful in its simplicity. You just take the total value of all stocks in the country, and you divide it by that country's annual economic output, its GDP. It's basically the ultimate bird's eye view of the entire market versus the entire economy. And yeah, it comes with a pretty solid endorsement. Warren Buffett himself called it probably the best single measure of where valuations stand at any given moment. And when the Oracle of Omaha speaks, investors tend to listen. So to make this super intuitive, think of it like this. The stock market is the total price tag on all of a country's businesses. The GDP is the country's total annual income. Now, if that price tag is somewhere around 100% of the income, things feel, pretty balanced. But what if the price tag is 200% of the income? That suggests the financial markets might have gotten totally detached from the real economy that's supposed to support them. And that is a major, major warning light. All right, on to our third and final tool, the relative alternative. And we measure this with something called the Fed model. Now, this one isn't about whether stocks are expensive in a vacuum. It's all about whether they're expensive compared to the main alternative. So what the Fed model does is it compares 2 things. First, the earnings yield of the stock market, which is kind of like the return you get for taking on stock market risk. And second, the yield on a 10-year government bond, which everyone pretty much considers the risk-free alternative. So it really all boils down to a super simple question. Where can I get a better return for my money?
I mean, if the stock market is offering an earnings yield of, let's say, 4%, while a safe government bond is only paying out 1%, well, then stocks look really, really attractive, right? But let's flip that around. What if a government bond is offering a guaranteed 5% yield? Why on earth would huge institutional investors, the big money, take on all the risk and volatility of the stock market for a lower potential return? The short answer is they wouldn't. When bonds start to look more attractive, big money starts to shift, and that can change the entire direction of the market. Okay, so we have our three thermometers, but the real power here doesn't come from looking at them one by one. No, it comes from putting them all together on a single dashboard so you can get a complete, unified picture of the market's health.
So let's bring it all together. Our dashboard gives us three totally distinct signals. The Shiller PE tells us, are we expensive compared to our own history? The Buffett indicator tells us, has the market lost touch with the real economy? And the Fed model tells us, are stocks still the most attractive game in town compared to bonds?
And that brings us to what is, without a doubt, the most important lesson of all. A market doesn't just crash because of one bad number. Real, true bubble conditions start to form when all the warning lights on the dashboard start flashing red at the same time, when historical valuations are sky high, and the market is disconnected from the economy, and there are safer, more attractive places to put your money. When all three of those things align, that's when a smart investor pays very, very close attention.
So you see, professionals don't guess if there's a bubble. They check their instruments. They compare things to history. They look at the big picture, and they always understand the alternatives. Which of course leads us to the ultimate cliffhanger. Where do these three crucial indicators stand right now, today? Well, checking those instruments is exactly what we're going to do in our next explainer.